Welcome to The Explainer. Today, we're diving into something pretty incredible, an astonishing Q2 2026 earnings report from Peapack-Gladstone. We're going to get right into the data and trace exactly how their bold strategic pivot paid off in a massive way, turning an industry-wide crisis into an era of unprecedented growth.
Think about the landscape of the financial sector lately. We really got to ask ourselves, how on earth does a regional bank take that severe, industry-wide panic of early 2023 and flip it into record-breaking earnings just 3 years later? It's honestly a masterclass in counter-cyclical growth, and the numbers we're about to look at are truly staggering.
Here's our roadmap for today. We'll hit their strategic bets amidst the volatility, the actual Q2 earnings inflection, core deposits and loan growth, that crucial wealth management anchor, and finally, their strong foundation for a bright future.
Kicking things off with Part 1, Strategic Bets Amidst Volatility, the Counter-Cyclical Pivot.
This timeline it's a perfect picture of counter-cyclical courage. Look back at the absolute chaos of March 2023. Bank failures, rate hikes, totally wild times in the industry. While everyone else was hitting the panic button, laying people off and pulling back, Peapack leaned in hard. By May, they were already snatching up seasoned NYC bankers. Skip to April 2024, they grabbed 13 whole banking teams, plus new leadership. Then we get the rebrand to Peapack Private Bank and Trust in early 2025, followed right away by a brand new flagship center in New York. They basically scooped up top-tier talent and prime market share right when the rest of the banking world was running for the hills.
Moving right along to Chapter 2, the Q2 earnings inflection, reaping the rewards.
So here's where we see the payoff. The strategy worked, leading to a massive earnings inflection by Q2 2026. The real magic here, incredible operating leverage. We're talking total revenue surging by 23%, and that is 9 straight quarters of growth, by the way. Meanwhile, operating expenses were kept on a tight leash, growing just 7% as things normalized. In the banking world, they're highlighting this as an insane 10-to-1 operating leverage. It proves those aggressive investments in talent and infrastructure from a couple of years back have fully matured. The engine is primed, revenue is skyrocketing, and costs aren't dragging it down.
And you know what's really fascinating? Seeing that positive operating leverage translate directly to the bottom line. An 89% growth in earnings per share is literally staggering. And let's be clear, this isn't some accounting fluke or a one-time bump. This marks their 5th consecutive quarter of EPS growth. When you invest heavily during a downturn, the ultimate test is whether that cash makes it back to the shareholders. An 89% jump? Yeah, that's a resounding yes.
Building on that exact momentum, check out their pre-provision net revenue. It shot up 70%. That strips out all the noise and represents their 7th straight quarter of growth for this specific metric. It proves beyond a shadow of a doubt that the core banking engine is just firing on all cylinders right now. Let's get into Chapter 3, Core Deposits and Loan Growth, the Operational Engines. So let's pop the hood and look at the daily operations driving those incredible earnings. A 31% growth in non-interest-bearing deposits over the last year, that is the absolute holy grail for a regional bank right now. Why? Because these accounts are essentially free money to fund the bank's operations. When the cost of capital has been crushing margins across the whole industry, growing your cost-free deposits by almost a third gives you a massive competitive edge. To put that in perspective, those non-interest-bearing accounts, that cost-free money we were just talking about, now make up a solid 23% of their total Q2 deposit mix. You've got another 50% in interest-bearing demand accounts and 27% in non-DDA. By aggressively expanding that crucial 23% slice, they're heavily driving down their overall cost of funds, and that feeds directly into those expanding profit margins. On the flip side, how are they actually deploying those deposits into their $6.7 billion loan portfolio? Well, they've smartly channeled 44% of it into commercial and industrial loans, which grew 15% year over year. And the discipline here is fantastic. This portfolio isn't concentrated in one risky area. It's spread across a whopping 386 different industries. They're definitely not putting all their eggs in one basket. The rest is carefully balanced out across commercial real estate, residential, and multifamily properties. It's a textbook example of highly diversified, risk-adjusted growth.
On to Chapter 4, the wealth management anchor, stability amidst volatility.
Now we have to talk about their secret weapon. It provides immense franchise stability. Unlike a lot of regional peers who rely almost entirely on basic lending and deposits, Peapack has this integrated, comprehensive wealth management suite.
Think about ultra-high net worth clients. They need the whole shebang: financial planning, investment management, trust services, plus really complex estate and tax planning. Peapack does all of that under one roof. With an average client relationship sitting at $4.8 million, they are locking in highly valuable, deeply entrenched multi-generational relationships.
And that targeted strategy has paid off big time, cultivating a massive $13.9 billion in assets under management and administration. This wealth anchor is spitting off steady, fee-based revenue that actually grew 13% over the last year. It even hit a 41% EBITDA margin for fiscal 2025. Having a predictable, non-interest revenue stream like this is a total game changer. When lending gets choppy or rates bounce around, this is the ultimate stabilizer for the balance sheet.
Bringing it home with Chapter 5, Strong Foundation, Bright Future, Sustainable Value Creation.
Finally, we need to look at the foundational health of the balance sheet to see if this growth is actually sustainable or just a flash in the pan. Good news for them: margins are expanding and efficiency is improving. Net interest margin bumped up 6 basis points to 3.32% for the quarter. The efficiency ratio dropped over 250 basis points down to 65%. Remember, lower is better there. It means it costs less to generate $1 of revenue. Tangible book value per share is also up 3%. And maybe the most important part? Problem loans are exceptionally well controlled. Their non-performing assets to total assets are incredibly low. They aren't just growing fast, they're growing safe, with absolutely pristine credit quality.
Which brings us to a final, pretty provocative thought. As regional banks keep navigating what's honestly been one of the most volatile eras in modern financial history, has Peapack-Gladstone just written the new blueprint for resilience? It definitely looks like treating widespread panic as a rare opportunity to secure top talent and grab premium market share pays off in historic ways. Thanks so much for joining me for this explainer. I hope this deep dive gave you a really clear look at how strategic courage turns into undeniable financial reality. Keep learning, and I'll catch you on the next one.